Welcome to the Takeaways podcast. On today's episode, I'm with a person I consider a legend of the ecosystem. Keet has been a part of the ecosystem for, close to 20 years now. He has done it all, he has seen it all, and I'm excited to hear what he's going to be able to share on today's episode. Hi, Keet, and welcome to the Takeaways podcast, man. How are you?
I'm very well, thanks. Always good chatting to you.
So, to start with, right, you have been part of the ecosystem since 2010, like at Knife Capital. But prior to that, you were, of course, part of the ecosystem. Yeah. So just give me an overview of, your time in VC in South Africa and how the ecosystem has changed since that time to now.
Sure, thanks. A lot has happened. Definitely positive things. When we started Knife Capital in 2010, it has a little bit of an origin story before that. And my interest in entrepreneurship is also a little bit before that. I was working in corporate. I was in a bank, Investec bank, looking after owner-managed businesses, let's say entrepreneurs, which generally is very difficult for a bank to bank them, because they don't have massive balance sheets. And talking about the businesses now, not the entrepreneurs themselves. And the bank sort of partnered with them through, overlends, structured equity. So I was looking at that and really got fascinated of how successful the net asset value of entrepreneurs are versus your traditional employed typical person with leverage debt, et cetera. So I joined an entrepreneur business organization called Revered Dragons. So Mark Shuttleworth was one and still is one of South Africa's most successful tech exits. He exited his business Thawte to Verisign in 99 or so, 2000, for I think it was $575 million in his early 20s. And from there onwards, did a few things, but established a VC fund called Revered Dragons. Myself and my co-founder joined to professionalize that fund or to take over some of the investment management functions. And then we approached Mark with a very entrepreneurial thought at the time to say, well, we don't want to be employees in a family office. Can we respectfully spin out our own company, and instead of being an employee, can you be a client? So that was essentially our fund one with Mark. But at that stage of the South African VC ecosystem, there were a couple of amazing individuals and companies which are still in and around the ecosystem. So one of them was Justin Stanford, 4DI Capital. Anton and the team still around, still one of the leading venture firms in South Africa. They were there. Invenfin, which was Remgro's venture arm, at that stage was led by Brett Kumail, who subsequently went on and co-founded Angel Hub with us, and essentially set up Flyisani Fund. And Invenfin themselves, Stuart Trust and those guys, they are still going in some shape or form. And the other team member sort of in the ecosystem was Andrea Bomertz. She had Hasselplattner Ventures, which was, also as a VC in the local ecosystem. And she actually subsequently joined Knife as a partner from there. So there was that, but it was very nascent. There was no institutional capital really behind it. Everything was built on the shoulders of high net worth individuals, whether it's corporates or whether it is Mark Shuttleworth, whether it's the Remgro Arms, or whether it is Hasselplattner Ventures, founder of SAP. So it wasn't really institutionalized, and I suppose very nascent. There wasn't entrepreneurs very rarely considered it as a venture option. It was more just sort of the angel ecosystem. And so that's what it looked like at that stage. Fast forward, and I'm sure we'll touch on the period in between to where we sit in 2026. There are many respectful funds that launched since then. The institutions, a little bit spearheaded by two events in the South African ecosystem called sort of Section 12J, which was a tax incentive for individuals to invest in venture funds. That subsequently has been cancelled, but it's a different podcast, that one. And then also the SASME fund. So because of the fact that institutions weren't backing the space directly, a bunch of individuals in South Africa, sort of the corporates, really some forward-thinking leaders, Adrian Gore from Discovery, Brian Joffe from Bidvest, and all that sort of went to the corporates, Capitec and those guys, saying, let's just all sort of put in money behind a fund that backs SMEs, and that's a fund of funds that backs some VC funds. So that's the long story of the local ecosystem. Yeah, in the meantime, in parallel, as you know, Africa did its bit in fintech and all sorts of stuff. So if, West Africa, East Africa became quite interesting with very respectful VC funds. Some of them run out of France, some out of London. If you look at the like of African Invest and TLCom, and even East, some of the friends we have there, Savannah Fund, and that in those days, and so it's a multifaceted ecosystem. I wouldn't say Africa is an ecosystem. I mean, each one has its pockets. We try and co-invest as respected VCs all over the continent. But mandates are sometimes different. Currencies, fund structures, what we look for. But yeah, I think it's definitely still not. I still have lots of thoughts around the VC model, but for this continent. But at least there are players that are thinking about how this should work.
I want to speak more, like on Section 12J. I mean, it had quite a broad impact on the ecosystem, and I believe the Knife Capital had like 2 funds under the Section 12J. What role did you think it played in helping a nascent ecosystem like VC then to be able to grow to where it is at the moment?
To answer that question, we have to sort of understand the nuances of the South African ecosystem. It's a little bit different it's a lot, every ecosystem is different, but South Africa is in inverted commas almost too developed for the development funding institutions to put money behind it. Most of our due diligence is convincing the DFIs offshore that we need their money. They're like, no, but you guys have like all these pension funds, you have a stock exchange that works, there's lots of money in South Africa. Surely, as a VC fund with track record and exits and all the rest of it, why do we need to invest in you? We're there to develop nascent ecosystems. So be like, no, we really need your money. Entrepreneurs sometimes think you have got to have a thick skin and pitch 100 investors, and everyone says no, and you get despondent. Trust me, everyone has said no to Knife Capital from an institutional investor. Have you spoken to any of the big banks? All of them. Any of the small banks, all the asset managers, all the major family offices, we've heard it all. In the period between us taking over the HBD Management Fund, 2010 to around 2016, there was literally no funding coming in. We managed the Shuttleworth Fund. We launched an accelerator called Grindstone. We did a couple of angel investments, and where we found really cool entrepreneurs to invest, backable entrepreneurs, we set up let's call it SPVs and back them through some friends, family, and family offices, So we kind of did that, but 12J changed the trajectory slightly. What that is, any developed ecosystem has some form of an incentive to just take the edge off from a risky investment in private individuals' hands. In the UK, they've got the EIS and those type of things. In the US, there's an incentive for professional investors, et cetera, But, mentorship capital, if you think about it, incentivize people that at least have some money to invest and an interest in an ecosystem to invest behind highly risky, early stage seed capital thing, and basically make, in the South Africa case, make that a tax break. So you invest in a qualified company that is investing in these type of companies, you could deduct that from taxable income. So we raised a couple of 100 million rand through 150, 200 individuals that they got the initial upfront tax break. Obviously, the returns later on also comes through, but it sort of at least gave us the ability to then raise Fund 2 and Fund 3 to a degree, which essentially got us over the line to get the SSME fund capital in, and then got to our Series B $50 million fund. So it was an important stepping stone. Unfortunately, it doesn't exist anymore. But I think the short version of why not is, I think it was implemented in a way where a qualifying company wasn't well enough defined. So what happened is people found, not illegal, but legal loopholes, so to say, well, let's invest in this thing and get a tax break, and let's do that and get a tax break and stuff. And it didn't end up being what it's intended for, which is also debatable what the spirit of investment is, I suppose. but it was intended for job creation, economic growth. If you're going to take taxpayer money that needs to go to the fiscus, invest it into high growth startups, that was the idea. And it was somewhat not quite that, I mean, it's very sad. I suppose from a knife perspective, we try to really stay purist around what we do, but I mean, it's there's pros and cons in all the models, less risk, high risk, investor money, tax breaks. I think all of that. There's all sorts of incentives. The SA Startup Act and those type of things that are looking at how we can potentially revive elements of it. Long story, but that's the medium short version.
In terms of the investment strategy, right, how did you invest in startups, considering the fact that the ecosystem was still new? So the notion of being able to return, venture returns was new to founders, right? How do you structure the investment strategy to ensure that you get, like all the multiples you need to be able to return the fund, to investors and more?
Look, yeah, we were, let's just first acknowledge the role of luck. I think at the end of the day, the chips bounce of the ball needs to go a little bit in your favor here and there. And we had some really good high profile exits in the early stages of our of Knife Capital, well, and throughout, but the exits in the early stages allowed us to have a seat at the table on the sell side negotiation side. I mean, luckily our team is a bit M&A heavy. My co-founder Keet van Zyl, he comes from that M&A environment. I come from investment banking and private equity environment. So yeah, we are emancipated accountants, let's call it that. But at the end of the day, we had some really good early exits to the likes of Visa, to the likes of General Electric, and a few others. And that kind of really put the lens on how do we invest? We actually invest to get an exit, and assuming that for the foreseeable future, the exit environment in South Africa or Southern Africa, maybe it's sort of changing a little bit when you go to West Africa, is not so many IPOs are happening or going to happen. And we solely focus on the most likely outcome is a trade sale to a strategic partner, Now, if you are a strategic partner and you have been through the mills of very professional IP lawyers or, people who look for ESG reports because they have a big listed US business that they need to, value attrition, all that, working capital regularization, intellectual property structuring, and, all of those complicated things, which seem theoretical for a startup. It's like, well, why do I need to worry about it now? I'll worry about it later. So to answer your question, our investment thesis is very focused on what does the perfect sellable company look like in 4 to 7 years, and let's work backwards from there. So that what it, treat our due diligence as a gap analysis. Get to know the potential partner universe on an exit side. Make sure that we show up, our companies show up on the so-called Gartner and Forrester type reports that there's, so if there's so we play both angles, and at the heart of it, build a sustainable, high growth, kick-ass, amazing company. That's what we do all day long, but build it to not be surprised if someone suddenly gets very interested in this company and makes an offer to invest, or put it into market at a certain time and get the best outcome. So we, it's a little bit, I suppose, of a longer answer to say it's not just looking at back the jockey and not the horse. Let's do all of those cliche things and build this high growth company. Our thesis is a good product does not necessarily equal a good company, and a good company does not necessarily equal a good investment. So you need to translate product into unit economics, into MVPs, into a TAM that can kind of execute on the channel. A good company has all sorts of interesting things and boring things, board meetings, ESG things, like staff incentives, all those things which are less exciting than AI and shipping product. But at the end of the day, if you are targeting an M&A strategic trade sale, you are up against a very professional M&A division of Visa or Garmin or UberEats or SoftBank or whoever. They don't take prisoners. They don't want to overpay for a business, and they don't really care that you're the most exciting startup to watch of 2006 in Africa. They care about unit economics and all the good things that needs to be in place. So I think that's sort of the short version.
You have been part of like a couple of the trade sales over the years, and there's a saying, companies are bought and not sold, right? So just take me through exactly how the process to sell a company starts, how it goes, and how it ends, right? Because I think we are, at a time in the ecosystem where we need a lot of the exits, right? Like, and people have to have an idea of how this process works. And you have been a part of a lot of the exits, like a lot of sales. So just take me through how that process works.
If you think about it as two processes, the one element of it you can control, and the other element is you can influence. So on the one hand, right now, somewhere in a boardroom in, let's call it Silicon Valley or Europe or Africa, Johannesburg for that matter, there's someone strategizing about this being disrupted, like we are, or what is next, or beyond, whatever the case may be. And that is the big company that says, listen, we've got money on our balance sheet, or we need to have a strategic play into China, South America, Africa, and we need to look at it. And then, so they make a strategic decision to say, let's look at Africa, for example, in our industry, who are the top players, and maybe we should build product for that market because it's up and coming, digitally savvy, upwardly mobile, all those good things that Africa is starting to offer. Or we need to look at who's in the place and acquire them, like what is basically a build or buy decision. They then instruct their team, who instructs McKinsey or Bain or Deloitte or all those guys to make a report of the top XYZ industry companies in Africa that is in the space. They look at them, shortlist, and start inbound interest to say, hey, Quicket, for example, one of our portfolio companies in the ticketing business, we are interested to get can we talk? And eventually those talks kind of, it's like, listen, can we have some more information on a confidential basis? Can we basically, are you for sale type thing, So that's sort of how the one process works. And, mustn't be surprised that process is carrying on all the time, but, companies are acquiring other companies in their value chain the whole time, including even in our portfolio. We have put various funding rounds behind our companies to acquire other companies in other markets to, for instance, if we go to Kenya, there's this decision of like, well, shouldn't one of our companies rather acquire a smaller player in that market who's already got bank accounts, clients, and that set up, and where there's synergies, and we integrate that team, or do we deploy a salesperson, put them on the ground in an ecosystem that we don't know and or that well, anyway, so that happens. On the other side, you have a company. These are the things you can sort of influence but not control so much. On the other side, you have a company. You need to understand. You basically need to build a high growth, sustainable businesses that those people should and could be interested in. You need to understand who those people are. So it's actually quite important. Your exit strategy needs to inform your growth strategy. Not for all companies. I'm just talking about for venture companies. Plot twist is VCs need to sell their company. So I'm just saying, if you're in for a permanent capital vehicle and you want to leave the business for your kids one day, maybe VC is not such a good idea, or you should from the outset structure a potential management buyout with the VC, and we've done a few of those successfully. But anyway, so you need to know who this partner universe is, who you're going to sell to. As per my example, if we're invested in a ticketing business like Quicket, who could it possibly be? Well, let me think. Eventbrite, Ticketmaster, some of the local, so I'm just saying, like, so you need to make sure that those people know about you. You need to form relationships, and that's kind of where the VC also can help, is to, through our network, influence the relationships with those third parties, not to the whole time say, are we for sale, but just so that they know that there's something happening. Send them maybe a quarterly update of where we are, visit them, how can we collaborate, those type of things. people buy, or companies buy companies they know, and people deal with people that they know and sort of get to know and trust over years. So you sort of influence that. At the same time, continue building a high growth business, good governance, and very importantly, understand your value or valuation. So companies often have an inflated sense of how awesome their product is, and therefore that needs to translate to a business valuation. It sometimes does at the earlier stage, but most often it's the unit economics that you are aiming for, or the financial model that you can put into place, where people are saying, okay, you have $10 million of revenue. I can compare that with revenue multiples in the industry of whatever it is, 5, 6, and therefore your valuation is 60 million, It becomes even more important to understand value in a trade sale, because what those companies are doing, those strategic big companies, they have also awesome companies that once were high growth startups and now are more at the later stage of their investment phase. They're taking their own balance sheet money to buy other companies or to partner with. If they are buying a company that's more expensive than their own trading stock, then they're basically losing value by acquiring a company. So there needs to be strategic value and all that kind of stuff. So yeah, those are sort of some of the things you can influence, and then it becomes more nuanced. Size of recurring revenue. Not all revenue is created equal. ARR, client distribution, offshore or hard currency versus local cost base, and all those great things while building an intellectual property moat. And remembering again, we're talking mostly about, in my conversation today, about high growth technology enabled businesses, and tech is, what is it? It's ones and zeros, and it's basically very much intellectual property, and those things need to be very well protected and so forth. So build throughout it a sell-side data room, let's call it that, while building a good company. And yeah, when it's on, it's on. And then you need to be able to provide a good one-pager, a good sell-side data room, updated management accounts, audited financials, good, where's your structure, is it Delaware, is it Amsterdam, is it UK, is it Mauritius, whatever. Those things need to be clear. Shareholder alignment, hugely important. But some of the non-success stories that we've had most of them has been because of shareholder misalignment. It's the number one destroyer of value of a company. So make sure that the shareholders are not confusing the direction of the company. If there are, I wouldn't say rogue shareholders, but if there is misalignment, see if you can clean up that cap table a bit. So there's a lot of work, stakeholder work to be done, and then make sure the founders and the management team and the staff are on board. And we have an exit workshop every year with our companies in their capacity as shareholders, saying, listen, this is what we all were aiming for when we did the investment 3 years ago. Has anyone changed their mind? Is there any other thoughts on the table, et cetera, et cetera? And sometimes there's other outcomes. As just a quick example, we did a company in a sort of sports radar technology business that deal with golf balls, tennis, soccer, goal line technology, all that stuff you see on TV when you hit a golf ball, or cricket, all tracking all of that through radar. And very successful company. We actually had someone come to try and acquire the company, and then the management team sort of said to us, listen, they feel that the journey's not over yet for them. They think there's a consumer product they want to still launch, XYZ, and could we not rather, at that pricing, which is the offer now been made, structure a management buyout, which we did successfully. It took a bit longer because now you have to leverage, finance and all that. But it was actually it was a good outcome for us, but the business is actually, I'm still on the board there, is doing much better than it did before. So maybe that says something about our value add or strategy, but it's just the way it works. So we partners, and shareholders need to be aligned. Any entrepreneur can make a due diligence fail if they are not on board on this journey.
In terms of trying to align the interest of the VC, like of the founding team, of the shareholders and the acquiring company, how long does that take? Because I'm thinking all of these parties want a certain outcome. How long does it take to ensure that everyone comes to the same table and the deal can go through?
Yeah, look, it starts even in the due diligence. It starts before the investment, just being very clear around the journey. I mean, the journey never works like the journey works. Even entrepreneurship, and specifically in Africa, is a is a very much a volatile path. But I think it's just authenticity. Get to know the people, so I think that's and get to know each other, and sort of it's maybe a little bit idealistic, but make sure that the entrepreneurial, or we try and make sure, but like in an ideal world, they also care about our business model, so they don't want an unsuccessful VC as the investor either. So just make sure the intentions are clear, and then and one gets it right and one gets it wrong. But yeah, I think that does lean on communication as always being the key stickler point in terms of communicate when things go a little bit sideways. It will. How does one deal with that? Our principle is always, you have lost the plot if you have to pull a contract out of the drawer and say, hey, entrepreneur, in terms of clause 12.3.4b, you can't do that. It's more conversations around how do these things work. I mean, the legal rights are protected, but it is just strategic alignment of the journey ahead, and just sort of a reminder of time is not our friend here. We have to at some point, and that is a challenge in Africa at the moment because of the lack of exits. A lot of funds have invested, but as you alluded to earlier, the whole point of venture capital is to return capital back to investors. The best thing we can all do as an ecosystem is to just show high returns back to investors, and the whole ecosystem from an investment perspective will solve itself. I mean, capital will flow where there is the most bang for buck, in terms of returns. And suddenly, if we as an asset class or an industry can stand up and be counted from realized returns, the money will flow.
We spoke on trade sales, right? I want to speak on IPOs. Why don't a lot of startups in South Africa IPO?
I wish it was different, but I think it's expensive, it's complicated. Companies which have, and it's not always the case, but companies which have a high reliance on intellectual property and they do have a moat around that disclosure pre and post the listing. It's just not a market where many listings kind of happen, and we are trying to fix that. And I think there are other exchanges, obviously alternative exchanges locally that's happening, potentially companies on AIM and Canada and other exchanges. I think, there are at least some Nigerian consumer businesses and fintechs which are leading the path. But I think it's more just complicated, expensive, not highly traded. It's almost the JSE is itself. It's not just the VC industry. It's not necessarily, there's not that many listings happening. So I think we are all trying to work this as an ecosystem, but those are some of the main reasons.
How would you say those conversations are going in terms of trying to align this JSE to become a place where like a startup can see and try to list on to be able to exit and raise capital?
Look, they are very engaging, and would dearly love to have this as a thriving IPO market. I think there is definitely, in my view, but it's not as simple. There's definitely a gap for some exchange, and maybe it's a Botswana or Namibia or someone that has sort of change the rules slightly around what can pension funds hold, how wide must the spread be, because you also want these things to trade. It doesn't help that someone listed and then the shareholders can't sell, because then the share price goes down again. So we have dabbled in the listing space as ourselves as Knife Capital, and it's it just seems to be, for a small company, you end up writing sense announcements and sending out quarterly reports, chasing the wrong metrics. Remember, that is sort of part of the problem with the listed environment, is that quarterly or annual trading updates and profitability and headline earnings per share, and those things are much more celebrated by the market from a pricing perspective than a long-term strategy to build a business that has a moat around a certain industry that will have a hockey stick in year 4 and 5, So that is some of the things. But yeah, the conversations are positive, but unfortunately, it's conversations. We don't have a clear path of exactly like a game plan.
The other exit avenue that's not, discussed enough is the secondaries, right? How would you say it is, in South Africa at the moment, especially at a time where a lot of the trade sales are not happening and, the IPOs are obviously not happening too. How would you gauge the state of the market at the moment?
Yeah, so secondaries is definitely the one area which has increased significantly over the last 3 years. I think people have realized that there are other ways of, on the one hand, I don't like to use the words cleaning up the cap table because it sounds like the cap table is dirty or anything. But on the one hand, they are giving money back to early angels or some people who has been in for a while to sort of consolidate some of that, or maybe a chunky investor that has a 6 or 10 or 20% shareholding, and maybe that fund is at the end of its fund life, or it's a shareholder that is a family office that has now changed their strategy, or maybe some angel that is at 80 and wants to rather cash in and doesn't necessarily want to wait for the big bird in hand is the only bird, as they say these days, and from an exit perspective, and rather take that exit. I wouldn't say challenge, just the reality of a secondary sale sometimes is that for the benefit of getting liquidity today, there's usually a discount associated with that. So let's say a company theoretical value on paper is $100 million. If you then make an offer to a minority without necessarily board rights and all those type of things in a secondary, it would be at a discount to that, which is still sometimes very much at a premium to what the investment. So instead of getting 5 times money, one would get 4 times money, but you still have an exit. So I think that's some of the things that is the opportunity, as well as a little bit of the challenge. But we certainly have increased our secondary allocations. I mean, we've done a few. In fact, we're busy with 2 transactions at the moment where it's a hybrid. Some of it is secondary, some of it is growth equity, and that works well, especially if one can use some of that secondary to give a little bit of it, not a massive chunk, because that's a different signal, to actually the founding team, or some of the key management, so just to take a little bit of cash off the table, pay off that bond that has been, but make sure that your kids are okay for the foreseeable year or 2, so that you can focus on the business. That type of thing also is not necessarily uncommon, but it's more like a big chunk of secondary. And then some of the funds, specifically out of Europe and South Africa, fund of funds, are looking sometimes on a portfolio basis to say, look, we know that people are struggling to exit. It's going to take another while. Let us sort of take the whole portfolio out into a different continuation vehicle, and the management team, then it's almost like you re-click the clock. And that's the hybrid between VC and private equity. Yeah, so we are very excited about it. And all I can say is watch this space, because it is something that Knife is strategizing with some partners quite aggressively around what should our next fund look like.
Whilst we're still on that conversation of the evolution of the Knife Capital, right? In 2023, you raised a Series B fund. What do you think is the difference between doing an early stage fund and a growth stage fund? How did you have to kind of try to adapt the team for the mandate of trying to invest in growth stage startups?
Well, I'll answer you that from 2 angles. The one is our own internal processes and things had to vastly professionalize and improve. And secondly, the way those transactions are done are also a bit different to, let's say, earlier stage of Series A type transactions. That one is less of an impact. But firstly, on the impact of Knife. So if you and I didn't actually truly appreciate the difference, but think about it this way: at one point, you're a couple of mates doing venture capital investments. So 2 co-founders, 3-4 partners, maybe an analyst or 2 in a back office. And the actual job is the same. We're very much rigid on find, make, grow, realize, risk and compliance, but find good investments, work with entrepreneurs, make the good investment, due diligence, legal structuring, all that type of stuff. The next hard work starts, grow the investment towards a realization strategy, and then basically doing all the risk and compliance stuff in between. So that sort of stays the same, but as I said, there's a difference between a few individuals investing in the VC space and cobbling it all together. And I'm sure VCs that listen to this will understand what I'm talking about. And then there's a difference between being a fund manager, so being a fund management company. And we all think we are until you actually have to own up to being a fund management company. And that is to do with, proper ESG reports. The reporting should be the same, but when you suddenly have institutional investors at the ilk of $50 million, that's there's just a professionalization. Our it's a bit more localized, but our financial services board license had to change from a category 1 to a cat 2 license. There's some overseeing on that. There's all sorts of things to almost take the fun out of it, because there's a lot more that you need to do about running a business, because you're always entrusted with institutions and people's money, but when you do start taking bigger checks, it is pension fund type money or more institutions that have reporting requirements to their stakeholders. And I think we a little bit had to gear up within an 18-month period quite fast, and employ more people and all that. So there's a ramp up there. In terms of the deal structures, not so much. I think that it does become, you can't do less due diligence for a smaller investment, but I suppose some of the instruments maybe are at the earlier stages more convertible related, maybe some safes involved, simpler cap tables, meaning there's maybe 2 or 3 co-founders and they need their first institutional investor. At the Series B level, you might have a cap table with already 1 or 2 other institutional investors, some secondaries, as you mentioned, and more of a consortium type investment approach. A company needs $10 million or $20 million, and Knife is providing 3 or 5, but there's also 2 other investors coming in. So you leading a transaction, and there's maybe some others coming in, and that has its own nuances, and also the legal jurisdictions. Typically in an earlier stage business, the companies haven't yet externalized their intellectual property, and it's again a whole different debate. But South Africa's got very rigid Reserve Bank approvals around and intellectual property. So to get follow-on funding, companies need to ideally structure themselves, and we are working with National Treasury and SARB how to make that more friendly, and that's all one. But I'm just saying, investing in a Delaware business or with US law and US lawyers is slightly different than investing in a jurisdiction where the company law and all the minority protections and stuff backwards, because you've seen the movie before. So yeah, I think those are some of the nuances. More co-investment happening, secondaries happening, intellectual property considerations, which are a little bit more higher grade, and consortiums investing together is probably some of the key differences.
In terms of the deal flow, at the growth stage, how do you think it is, like in South Africa at the moment? Because I'm thinking that if you are investing a Series B, though the startups are less of a risk, you are under more pressure to be able to have a return on investment, unlike at early stage where you just need one or two companies to knock it out of the park, then you're good. At the growth stage, it's a bit different. How do you think the deal flow is? Do we have enough startups at the growth stage to be able to justify what you as a VC can be able to invest into them?
Look, it's a challenge. I'll be honest. I mean, there is lots of deal flow. So that absolute given across the continent. So deal flow, the entrepreneurs are doing their bit. So they are building amazing businesses. They have all of that. So there is absolute amazing deal flow. But then the nuance of investing at the right valuation with companies, I wouldn't say passing or failing a due diligence, but being able to address certain growth challenges, the advent of AI, which really has blown open and destroyed or will destroy some SaaS-based industries, and all of us had to skill up there. So if you put all of that into a fray, it becomes quite difficult to find the kind of Goldilocks type company, the perfect company with, high SaaS metrics, good unit economics, just a few founders and not so much of a complicated cap table in the right jurisdiction that has an industry. I mean, there's a few interesting industries that we like at the moment, cybersecurity, ed tech, invest in space tech, and some things around health. So just some industries which are, I wouldn't say AI proof, but are, can kind of keep up with the times. There the deal flow suddenly becomes less. So we looked, just for context, we looked at 271 transactions last year, or deals last year, of which, and those are the ones so that's a lot. I mean, it's almost a deal a day or every second day. And a lot of it fall out the funnel. So yeah, deal flow is good, but I can't say that is not a concern to find deal flow that's, I wouldn't say perfect, nothing's ever perfect, but that is highly investable. It really drops off to a few transactions. And then those few makes it then extra complicated is they have options. So then and it's awesome. I mean, I love the fact that good entrepreneurs have more than one term sheet on the table, and now they have to choose their best suited investor. It's not so much more about the money, and I'm talking about the top echelon of businesses. They have choices. Sometimes you get outbid on pricing. Sometimes it's a better fit for where the company needs to be or go next than let's say Knife Capital. And sometimes we're a better fit than another business, and that's also sometimes a bit complicated because it might be another VC that would have wanted to co-invest with you, or your friends in the industry that you have now outgunned. But I suppose at the end of the day, it's not ideal, but it happens. We co-invest where we can. But to answer your question, deal flow, amazing companies, but to get that into a growth type investment that has still got enough growth percentages left, that can still return 3-5 times money, that's in the right industry and well priced now. I think a lot of companies fall short on the pricing metrics, and then we can structure around that and all that. But sometimes entrepreneurs don't like that. So like, why should there be a ratchet mechanism or a milestone-based investment when another investors just give me the money with no questions asked? This sounds like a lot of trouble. So one does sometimes lose transactions by being too clever for your own good.
Still on the topic of deal flow, I want us to track back again to the early stage. The first time we spoke, I was asking you about the grindstone, like accelerator. And a lot of startups that started at grindstone eventually grew on to the funds, and then a couple were able to achieve an exit. What's the role that you think, acceleration plays in kind of being able to create these investable startups that are also going to be able to exit?
An amazing role, and there are, but the acceleration models have also evolved. So gone are the days where you can run a 8-week program, take a 5% equity and not really add much value. So I think where the programs are more network or value adding driven, or where there's more of venture building studio elements to it, or that's actually more valuable for a startup. So I think the way to look at it is there's a lot of help that early stage companies need. The ecosystem is broken at the early stage. There's market failure at the early stage, meaning it's very difficult to find a couple of $100,000 or so. It's, once you've sort of survived through all of that and you become eligible for $5 million or 10 million, it's almost, I wouldn't say it's never easy, but we all get stuck there, specifically in South Africa. And unfortunately, there's so many specifically Black and female-owned startups that are just stuck there, where they can't quite get to the level of Series A, just because where do you find the angel investors and there aren't many seed funds. It's just the economics and if the mathematics of a small fund doesn't work. And even when the funders finally give you capital, they push you to be a bigger fund because you need to be sustainable on the 2 and 20 model. And then you will automatically increase your deal sizes. If you're a $50 million fund, you're not going to do 50 $1 million deals. You're just not. So you're going to do 12 deals that are of the ilk of $3 million plus. It's just the economics of a due diligence. It just doesn't work. Your team structure doesn't necessarily work. There are models that work, and some like Launch Africa. Those guys doing an amazing job of plugging that hole, but we need more of that, and we need government to support first losses and all the rest of it. Back to the role of accelerators, if one can kind of bridge that gap to a degree of investing time and or money, or network, so it's not quite what we set out to stand for, but KNIFE is knowledge networks funding. KNF is also what our fund's called, and that stands for knowledge of how to build businesses and networks of how to connect to other funders. Majority of the grindstone accelerator businesses that have raised funding have actually raised funding not from KNIFE, because we've connected them with early stage funders or individuals, or we co-invested, or we put in a little bit of a seed money, which then signaled that we are serious, that we're backing this entrepreneur, and that multiplier effect has really, really worked. But yeah, hugely important. Some sort of, let's call it networks like the Endeavor networks, doing some amazing work throughout Africa. There are some really credible, but I think hugely valuable thing, as long as it doesn't waste the startup's time. No one wants to come and listen to some people being clever in a workshop. They want to, give me a client, give me capital, give me a network, or help me structure my intellectual property and build a financial model, than giving me a lecture of how it works. So that's, roll up your sleeves as a accelerator venture building. And there's a lot of those models happening, not enough, but it has evolved.
Another aspect of the VC, the model that's not understood, is that you as a VC still has to go out there, and raise capital from LPs. And, if you look at the LPs, you have your DFIs, you have family offices, etc. And all those institutions have the mandates that are there. And you as the VC has to ensure that, the fund that they invest into, is able to meet those mandates. How complex is this process for you as a VC, and how do you try to align the interest of all the LPs in the fund that back you?
Again, you need luck and timing play a role, because we form, and we've got fantastic relationships with potential funders for 7, 8, 9, 10 years now that still hasn't invested in us, but not because they could or should. It's just that they didn't have a fund at the time that we were raising, which was looking to invest in a company that included South Africa and Series B. So you need to stay close to these investors and form long-term relationships, be able to hit them in the right timing zone. There's not always funds available. They also have their stakeholders that they raise from, and sometimes it's there and sometimes it's not. So one has to study these mandates. Returns trump. A lot of people will forgive a lot of things if you can show them what your last fund did, or you've had another exit. And there is definitely some success stories in the ecosystem. People back an ecosystem. And two interesting things to remember. one of the LPs that did the due diligence on us in to invest in our fund said, listen, I've read the documents and I know you can pitch knife, but maybe you are good at it, maybe you were lucky. Pitch 3 other VCs to me in your ecosystem. Tell me how they've done. What is that going on in their portfolio and stuff. I'm investing in not a flash in the pan. I'm investing in a rising tide, and that was quite interesting. My partner Davey phoned me after the call. He said, "Geez, I hope the other VCs pitch so hard for us as you just pitched for them, because I mean they." So that's the one. And then the other question one of the LPs asked me is to say, "Listen, I've read your success stories and your exits, and it's fantastic that you guys have done all these things, but I want the phone numbers and contact details of 3 of your failed investments. I want to chat to those entrepreneurs. How did you treat them on the way down?" So that was, I thought, so insightful. It's like, oh my goodness, yeah. So that's sense. So anyway, but to answer your question, I always thought we could pass the due diligences. We haven't done everything right, but we've got track record, we've got pedigree, we have some really cool portfolio companies. We've got a great team. We've learned a lot, have some battle scars, but I underestimated the orchestration of the different mandates of these companies. Some are more interested in Africa. Others want to exclude North Africa because they've already invested in a fund in North Africa, if you know what I'm saying. Now, your other, specifically South African investors, are very interested in South Africa. They are just a little bit more hyperlocal focused. The DFIs want to, have the typical East and West Africa story. So to kind of get, we've got 9 or so different LPs, which include some, they're all amazing in their individual right. It's literally the IFC and Standard Bank and Family Office and the SME Fund and Fireball Capital and Africa Grow, which is Allianz and KfW, DG, and a few others, which are really, really top class LPs, and they lean in, they help us and all the rest of it. But sometimes difficult to orchestrate these different mandates. And we had to say no to a few LPs that just couldn't fit into this mandate, but luckily we had one LP in South Africa, the Mine Workers Investment Company, and one LP internationally, which was the IFC, that came in first, so they did the first close. So that sort of really helped set the tone around. The other LPs could do diligence us almost, I wouldn't say via them, but it does help. So it's very important getting the first signals right, because then, once they've signed the documents, it's then quite difficult for other LPs to come in and say, well, we're not happy with that clause and we're not happy with that clause. It just becomes easier, but it's never easy. And but you need to understand those mandates, stay close to them. It's a long game. They might not be in Fund 5, but they may be in Fund 7. Investment returns. At the end of the day, that's what it's all about.
Let's speak more, like on the role of AI. We have seen how much in the US, in Europe, AI has had an impact in the valuations of startups. How do you think it is, like in South Africa, from your POV as a VC? What role do you think AI is going to play, like in the VC ecosystem?
As I mentioned earlier, it has affected valuations positively and negatively, but it's more affected. Some people are just a bit confused about, well, all of us, about what is the actual impact, when if you don't keep up. And so we've actually spent a lot of time. I thought I was done studying, and I had to end of last year did sort of some AI courses and all the rest, of just like keep up with the pace of things. And if you combine AI and crypto and the way people do business and the disintermediation of a lot of industries, it could negatively affect valuations of certain businesses just because of uncertainty. But on the other hand, it's also been positive on many businesses that could jump onto the AI train earlier on and understand this animal and bring that into their processes, client acquisitions, and all the rest of it. So, and those businesses have increased their valuations. But it's a scary and exciting space to be. But it is a bit of a fasten your safety belt strategy, because it does, and it's had more of an effect on our portfolio because we need to help strategize and advise from a board perspective and from a shareholder perspective. What's next? Should we invest more capital behind this animal? Are we done? Did AI just take away our moats? It's more that.
It reminds me of, at the peak of the cycle where, like a lot of startups, especially on e-commerce and fintech, had raised at these insane valuation. And when the peak came down, it became a problem because then you either had to do down round or you had to sell because you just could not be able to justify the valuation that you had at the peak of the cycle. Do you think the same thing can happen in AI?
Yeah, I mean, it is cyclical, and there's no shame, or it's part of the game. To certain cycles will assist in circles. Certain companies would be on the wrong side of a cycle, and an investment thesis 3-4 years ago versus in the same company today would look different. Yeah, there will be down rounds, there will be blood, and some companies that maybe were product businesses will have to down pivot to consulting businesses. Their business models change. I mean, we've seen some of those effects, and as I said, we've also seen the opposite effect. So it ramps up or down very quickly, but that's the nature, I suppose, of a portfolio approach. I think if everything is in the same industry and the same sort of thing, then you're at risk. But if you have a diversified portfolio and a diversified client base within your portfolio with recurring revenue streams and long-term contracts, you should be all right.
One thing that always interested me about the portfolio of Knife Capital, both from POV of invested companies and the exit, is that there is a fair kind of balance between, like enterprise companies and consumer companies. How do you think of this from your view as a VC? Do you favor more of like consumer startups or more of like the enterprise startups?
Yeah, there's room for both elements. I think that because we invest across the continents, I must just say, and sometimes opportunistically beyond, but we are mostly South Africa focused, and we know this market very well. And that, to be quite honest, is more of a B2B market for us, just because the fragmented B2C ecosystem in this country. But if you look at countries like where there's a lot of humans and a lot happening, like Nigeria, that I wouldn't say it's more tailored to B2C, but like it's, you could probably envisage that is a little bit more, there's more success in that market. So yeah, we are B2B heavy or more enterprise consumer. We do like the software that runs certain ecosystems, like software that runs schools or software that run gyms, or enterprise software platforms that switching mechanism between consumer groups and not. But those consumer groups are not necessarily. It's more small businesses or schools or those type of things where it's not necessarily individual humans, because it's difficult to market to them unless you got a lot of money, like Amazon or whatever. You pump years of money behind it to build your moat, and we just don't have that time or that balance sheet.
As we close off, right, you have been in the ecosystem for 20 years or so now. Would you say the VC model is working for our continent? What's working, and what do we need to work on to make it work?
Okay, the short answer is no. I don't think it's working, and the reason for that is I think it's an inefficient switching mechanism. So think about it this way. Everyone, we all know this. There is lots of money available there's lots of money for good ideas, for good businesses, for entrepreneurs. On the other hand, there is no doubt that in across this continent we have massively innovative entrepreneurs doing their thing, and they are absolutely backable. Then what is the switching mechanism in the middle to get the money responsibly to the entrepreneurs? And yes, the VC 2 and 20 model has been sort of traditionally, the model. But the timelines to exits are longer. It's not, there's just the IPO market's not there, as we discussed. There are certain things inherent to our ecosystems that doesn't quite translate itself perfectly to the Silicon Valley type model, where there's different factors at play. I don't have the answer of exactly what the perfect model looks like, but I definitely am spending my waking hours on what it should be. And so are many of the other players in the ecosystem to say, well, hang on, maybe it is a little bit more distributed. Maybe it is a bit more rooted in, anyway, who knows? But certainly, I don't think the model it's not totally broken, because it's definitely serving its purpose. And VCs like ourselves are raising good capital, making good returns, but there's definitely inefficiencies in the system. And if you now think about, and I'm not saying AI should enter the race here, but it should. If you now think about the fact that we are working in an ecosystem where things should take days or weeks versus months, and all those type of things, capital allocation, we can fix. Well, fix is not. It sounds like it's broken. It's not broken. We can improve the efficiency of the switching mechanism, which is the VC. But it's been fascinating. Hopefully there's some pearls of wisdom, or some people disagreeing with me. That's also fine. We don't have all the answers, but we continuing to build an industry together, and I'm very excited about it. By the way, I think the entrepreneurs have been really focused on building sustainable, long-lasting businesses with good moats, specifically on this continent. At the same time, lots of macro tailwinds in our favor. So I'm absolutely doubling down for the next phase.
All right, Keet, man. Cheers. Really, really appreciate your time, and have a great day, man.